So, guys, as expected, the Federal Reserve decided to pass on raising interest rates for now, but it didn't rule out the possibility of another hike in November. They said it all, quote, depends on the data. But so far, we haven't seen a recession, and the economy seems to have picked up some steam. So some are wondering if the Fed has a clue. That's kind of been a common thing for a while, I believe. What are you telling your clients?
Yeah, the question there is wondering if the Fed has a clue. The Fed doesn't probably have a clue really at all, and does anybody at our government. But, the million-dollar question here is, will Fed rate hikes affect the stock market? And really, if you look at the relationship between the stock market and interest rates, it's somewhat of a complex and it can be influenced by various factors. But in this segment here, we're going to try to break it down for you so you can make a more intelligent decision about what to do with your money and how to position your portfolio moving forward. In general, when interest rates are high, it can have both positive and negative effects on the stock market. And the actual impact is going to depend upon, some other specific circumstances. So it's not just all about interest rates. Here in general, though, are some of the ways that high interest rates can impact the stock market. First, it is very possible that you could have lower stock valuations. So what high interest rates do is they tend to lower stock valuations. That's because higher interest rates really increase the cost of borrowing from consumers to companies, right? And so as companies have lower profits because of higher cost, that tends to lead to the lower intrinsic stock value. And as a result, stock prices may decline as investors really revise what their expectations are for corporate earnings. The second thing that you see is there's more competition from bonds and fixed accounts. Right now, if you look at the fixed interest rate environment, we have money market accounts that are paying over 5% interest.
Sure.
I've seen other fixed investments that are at the 5.5% or 6%. So when you have the competition of risk-free investments, the investor has to determine, is the risk premium for putting their money in the stock market worth it, or are they better off looking at these other fixed accounts? And again, with the markets being an auction, so the more people that take money out of the stock market move more into these higher fixed accounts, that puts further pressure overall on the stock market. Number three is how that trickles down as you look at reduced consumer spending. So, we all feel the impact of higher interest rates. Really, when it comes to the cost of borrowing, whether it's automobiles or whether it's the pass down expenses that we see with things like going to get food or fast food, mortgages are more expensive, car loans are more expensive. All this stuff really adds up. When interest rates rise, that further impacts some of the consumer spending habits that are out there, and it can lead to reduced consumer spending, which can cause a negative impact again on earnings of companies in sectors like the housing, the automotive, the retail industry. So you've got to be a little bit more selective on where you want to own investments. Number four is, speaking of where you own investments, the category of stock investing, if you have growth versus value, higher interest rates can have a more impact on growth-oriented companies because their valuations are also based upon expectations of their future earnings. Like, what are they going to bring out in the future with their growth potential? And with interest rates rising, their future earnings are now discounting at a higher rate, causing growth stocks sometimes to underperform. We saw a lot of that happen as interest rates last year really started to take off and growth stocks struggled a little bit. Now in 2023, we've seen a little bit more growth stocks come back. So you can, number five, you can benefit from more defensive stocks. And I think, here we are at a nice run-up of the market. This is where an area that can be more attractive today. Some investors may seek some refuge in defensive type sectors. Particularly these are companies that are consumer staples. These are companies that people need on a daily basis. This can be an area ultimately that's been kind of ignored. I mean, we've seen so far in this year in the stock market, if you take the S&P 500 index, the larger, they're called Magnificent Seven, have been the driving force for a majority of the performance, and a lot of those other stocks have been ignored. So some of those stocks could create a better valuation looking forward. Government bonds. We talked a little bit about the government I bonds last year, with where they're tied to interest rates, and government I bonds can still be an attractive alternative for somebody who doesn't want type of market risk. But there's other economic impacts and factors that are going to not only say that interest rates are not the only driving factor and how to make an intelligent decision of where to go forward. In fact, this is the conversation that we're going to have coming up at our Economic Summit. It's October 11th. It's at the Hilton Garden Inns at 6 p.m. And we're talking about how to put the odds in your favor. We have an incredible presentation lined up, going to give you more ideas, talking about how to position your portfolio through taking advantage of these fixed rates, as well as understanding the market conditions and strategies to not only survive, but thrive in what could be a crazy year with the election coming up. So again, arhq.com. Click on the events tab. We'd love to have you come out to our Economic Summit and learn more.
Again, so they know how many people to account for, it's coming up right around the corner, October 11th, arhq.com, the events, find out more. Or if you just want to sit down and speak with the guys and start developing that plan, perhaps you can't make it to the Economic Summit, that's fine as well. The phone number, 419-794-3030.